how important is it?
I mean, for us, I mean, if the basis
getting it right,
points,
too.
I mean, if the basis points are 100 basis points higher interest, it really doesn't matter. I mean,
Okay.
we're looking at what can we do with a business to take earnings from one level to another by adding technology, adding international markets, changing the business, and that's kind of background.
Okay. So even though things might be choppy, you don't think it's going to be choppy for years? That might affect the growth pattern or trajectory?
No, I think it affects different industries differently. So if you're a fashion retailer, you may get hit very bad if you're upgrading the electric system in America, which we're doing, or you're providing life science supplies, which we do, or you're doing digital transformations. Those industries should do well no matter what. And then if you can improve those businesses, you're in a good industry and you...
From Bloomberg Business Week, and it's got a great headline. Nobody knows where the red line is for cyber warfare. This is certainly a story of our times. Let's get into it with Bloomberg's Katrina Manson joining us right now, along with Joel Weber, the editor of Bloomberg Business Week magazine. Joel, I feel like when you talk to CEOs, everybody, this is something that we're all concerned about, and certainly watching the Russian war in Ukraine, this is something that, again, is top of mind.
Yeah, on the corporate side, I think cyber, especially when you talk to chief technology officers, it is a space that it just never ends. The threats just continue to multiply. Budgets keep going up because of it. But really, I think what Ukraine showed is this quiet fight that continues to escalate. That is a national security matter. And the peg for this story of Katrina's was this cyber event on May 4th and 5th.
How you prevent escalation of cyber attacks. And I should say the jury really is out among academics on what happens when there's a cyber attack. Do things get worse as a result? Do things even get a little more relaxed? Does the air come out of a crisis? And could you ever cross the threshold of actual war through a physical cyber attack? And those are some of the things that these academics and government officials and commanders of the US cyber forces, who of course are conducting offensive missions, are going to be looking at.
So interesting, Katrina, because as Carol mentioned, we talk about it a lot from the company's perspective, but I'm wondering the government's role here and to what extent the government can actually protect Americans. And also when we think about Europe, the government can, protecting Europeans here, because it really seems to me, again, a layperson here, that the people who are doing the hacking are one step ahead of regulators.
That's exactly been the bind that the government's been in now for years. And you've seen a bit of a bifurcation. So there's been intellectual property theft. There's been attacks on critical infrastructure. Of course, when Colonial Pipeline had that ransomware attack, I'm sure people have heard about it, the fact that Americans were actually queuing for gas for the very first time, lining up, I should say, forgive my Englishism, that had such an impact on, I think, the psyche of how people in the country from cyber attacks, that the government's really trying to see some changes. As you indicate, it's really hard to get the private sector to do the job of the government, of national security. And there's been a confluence, an attempt at increasing sharing, really with bodies that are often mutually suspicious of each other, to try and build that trust and to try and defend the country better. When it comes to a slightly different area, of course, Russian cyber attacks on Ukraine, we understand that they, according to Microsoft, have been destructive and relentless. And Russia, the Biden administration has said, is thinking about doing attacks on U.S. critical infrastructure. Now, that means defending by private sector that runs critical infrastructure, but also the U.S. and its military is doing a tremendous amount to look and try and work out where people are on networks, what they can see, and also what they can do. And that's where the question mark still is, this idea of deterrence. Cyber Command General Nakasone has really, instead of talking about threats, what would the U.S. do if there is an attack in response, said you've got to get out there. He says that the best defense is often a good offense. And in the last 4 years, he's really built up a much more aggressive stance in cyberspace.
Katrina, you mentioned him, and one thing that I found was really interesting.
Okay, guys, traders, please place your stop for Bitcoin 1% below our actual order. So at 38,436. Let's place stop 38,436. Let's do it again. Okay. And we're already in profit. So if you followed my trade, if you're already holding position, well done. We're already in profit, so stay with me and we will close this trade in profit. For our strategy, please go to company.co.uk. Okay, stay safe, guys, and I'll speak to you later. Nice trade.
Vulnerabilities, and you can't guarantee that you'll act in a certain way on a given day. And that's why he's become much more forward-leaning, so that instead of waiting to be attacked, he wants to say that the U.S. is out there on foreign networks, which is a big thing to be, outside U.S. borders, but looking at what people are up to.
Katrina, another thing I just wanted to ask about is, I think that there was an assumption with Russia's invasion of Ukraine that cyber would be much more in the fore, at least in the headlines. Has that surprised people, the lack of kind of ongoing cyber threats?
Forgive me, just repeat that question.
Yeah, so I said, Katrina, it's sort of surprising, I think, among experts, and certainly part of your story, is that there had been an assumption that there would be much more cyber warfare in the Ukraine-Russia conflict. And perhaps there has been, it's just been sort of behind the scenes and much more quiet than anticipated. But how are experts who are monitoring cyber in general and cyber warfare making sense of how that's been unfolding?
Yeah, there are two questions there. One is, has it actually really been as insignificant as some at the beginning have thought? And then, of course, why? And cyber attacks were expected as a prelude to war. And in fact, the Russians, if it is the Russians, do seem to have taken some considerable actions. Viasat, their satellites were affected. Their Ukrainians have said that they have 3.5 times as many cyber attacks this period of time during the war than they did last year. I've certainly spoken to one Ukrainian head of cybersecurity at a critical infrastructure firm who said that phishing attacks went up from 22,000 in the whole of last year to 700, and I think it is 68,000. So there is an enormous shift in cyber attacks. But I think the kind of damaging cyber attacks that people might have expected, some haven't been seen. They may still come, but one of the reasons people think that is maybe Russia thought they were going to win quickly. Another reason...
Katrina, we have to jump in, and we highly recommend everybody go check out the story on the Bloomberg and at Bloomberg.com. Katrina Manson and of Bloomberg, and of course Joel Weber, the editor of Bloomberg Business Week magazine. You are listening to Bloomberg Radio.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. We have about 60 minutes left here in the trading session on this Monday afternoon. Romaine Bostic out in Beverly Hills. Taylor Riggs back in New York. Katie Greifeld in for Caroline Hyde. And we're now joined by our colleagues, Carol Massar and Tim Stenevec, who I'm told also are here at the Beverly Hilton in some undisclosed location. We welcome our audiences across Bloomberg Television, radio, and YouTube. Another volatile day in the markets, guys.
Yeah, another volatile day in the markets, although I got to say, so much activity. And from what I'm hearing, I talked with them on a panel about retail earlier, and we talked about cautious optimism. That came from the CEO of Lowe's, guys. So that's kind of what we're hearing, Tim.
Well, that cautious optimism not playing out in the S&P 500 today. It's down to its lowest levels as we speak since April of last year. And at one point earlier in the day, it was at its lowest level since April 1st of 2021.
Yeah, you're starting to see some red on the screen here. Remember, you guys, we were coming off of one of the worst days on tech on Friday that we hadn't seen since about September of 2020, and one of the worst weeks in the NASDAQ 100 going back since about 2008. So, Katie, sort of that negative sentiment, it continues today. You're off 1% or so on the Dow and the S&P, and you're off about 0.6% on some of the big tech stocks as well.
Absolutely, Taylor. I mean, no relief at all after what a brutal April. And if we look on the sector level, we can really see just how negative that sentiment is. You have 10 of 11 S&P 500 sectors in the red. Communication services just hanging on. We're actually seeing a bit of a pop in Netflix, in Meta platforms, but still really across the sector level, a lot of losses there.
I want to bring you another big loss that we're seeing, Katie, in the tech sector as well. You mentioned Meta, of course. I want to take a look at Amazon. Now, of course, we did get that unionization vote that Amazon defeated those efforts, but you're still seeing shares fall about 3%. Remember, on a macro story, this was a stock that lost about $250 billion in market cap on Friday. That was the second worst loss for a company ever in terms of market cap. Pushing us forward to earnings, we did get some corporate results. Of course, Moody's is kicking off about 163 earnings reports that we will get this week alone. But of course, this company cutting that full year guidance, so that impacting the stock. You're off about 6% or so. Activision Blizzard, Romaine, we did this for you. Buffett increasing his stake in the company, owning almost 10% now ahead of the merger with Microsoft. A big fan of some of that merger arbitrage, so the shares are up about 3%. And Align Technology, this was one of the worst performers in terms of sort of the big tech stocks that we had in April, getting a boost today by about 4.5%. Of course, some reports that the CEO continuing to buy shares. So, of course, when we think about some of the bigger share buybacks, that, of course, sort of helps this company. Carol, I think another big theme for these markets is we digest sort of the micro, the quarterly results, and then the macro here. And, Carol, what I'm showing is a chart of the quarterly, I should say really the rate hikes that we're expected to get from the Federal Reserve. We're going to kick it off, of course, on Wednesday to start. On the bottom of your screen in white, the market firmly pricing in 50 basis points easily for at least the next 3 meetings. Nothing about this market in the big red on the screen is changing that narrative.
Yeah, and that really makes us all wonder about the valuations, right? And maybe that it really explains some of the pressure that we've seen, especially in some of those big tech names, right, which have just really sold off big time. Mark Rowan, who's the co-founder and CEO of Apollo Global Management, caught up with our own Eric Schatzker, and they specifically talked about valuations in the technology sector. Here's what Rowan had to say.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter, and the entry point doesn't matter. So I think people who have benefited from this extreme low rate, high liquidity environment where growth, all manner of growth have been rewarded, I think that's where the greatest correction will come.
And that, of course, is Mark Rowan. He was talking earlier with our Eric Schatzker here at Milken. He's the co-founder and CEO of Apollo. But this is the thing we're talking about, this reset coming out of the pandemic, higher rate environment. We talked a lot about stagflation here already at Milken. You know, what is the right value for so many of these publicly held companies?
Yeah, Carol, what really stuck out to me from that part of the conversation was that Rowan said that's where the greatest correction will come. Not necessarily that's where the greatest correction happened already, because we're talking about some big names that are down 50, 60, 70% from their all-time highs, Romaine. So how much further do they have to go?
Yeah, but I also think you have to kind of layer it over. This idea of private markets versus public markets. Private markets is where you've had the yield And if you do get sort of some competition from those inflationary pressures, and I guess from yields itself, does it take the bloom off that rose? And what we're hearing from a lot of folks in Milken is no, at least not yet, that the resiliency here could continue at least for another year through 2023. Maybe it's into 2024 where you have to start worrying a little bit more.
I mean, even still, we have seen sort of IPO volume really cool down. We have seen SPACs cool down. Not a lot of people are coming to the public markets in the way that they had been. And this is all filtering through into financial conditions. I mean, we just in the past week have seen such a big move lower back to really these 2020 levels. So this is all what the Fed is watching as we head into that big meeting on Wednesday. Finally.
Is the Fed watching real yields? Romaine, blink and you missed it. We're up to about 12 basis points finally or so on the 10-year.
I've been watching. I got a Bloomberg terminal here. The terminals work out here in Los Angeles.
Oh, good. Yeah, so we have some, when we think sort of broadly about the tightening of the financial conditions, real yields is at least perhaps one thing that the Federal Reserve, Carol, is looking at. Otherwise, it's sort of a continuation of a big lift in nominal yields, now the highest going back since 2018. But you, of course, there on the ground continue to hear from people that I think talk about still the resiliency and the strength of this consumer in the face of those higher inflation expectations.
You hit the nail on the head, Taylor, when you talked about the consumer, right? We talk about how important it is, of course, to the U.S. economy. Consumers are still shopping. They're coming out. They're going out. I just talked with a bunch of CEOs in the retail sector, and they are seeing consumers, whether it's on their home or whether it's clothes to go back to work, clothes to go out, they are still shopping. But how long will that continue? And I think, Tim, that is one of the big questions.
Yeah, it makes me think also of what Citi CEO Jane Fraser just told our team out here, Sonali Basak and Scarlett Fu, that she's actually right now more concerned with the European consumer than she is with the American consumer.
Yeah, there's been a lot of talk here about global markets, particularly in Europe and to a certain extent in Asia, and what that means. I can tell you just on the ground, when you look around here compared to what we saw in October, a lot more Europeans on the ground here making deals or at least talking deals than what we saw back at the October Milken conference.
That's a really good point. There's a lot more of everyone here at Milken on the West Coast. All right, guys, we're going to be back in less than an hour's time. Our cross-platform coverage on radio, TV, and YouTube. We are here on the West Coast. We've got Taylor back in New York. We're covering it all. We'll see you again. We'll count you down to the close on this Monday.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So I feel like it's such a... Ooh, sorry.
Hello.
We're getting a little bit of an echo.
That's okay. We'll get working on it. What were you saying about what you're seeing in Milken?
I think just the juxtaposition about concerns in terms of what's going on in China, the slowdown, the lockdown, the COVID zero, although they're committed to growth and just trying to figure out the optimism that we're seeing here. And I'm getting to hear my voice twice.
She sounds so nice. We hear her twice. I think that's okay. Hopefully our viewers and listeners not hearing us twice.
No, that would be scary. There we go. We've got it.
It is so fascinating to think about the tone difference here, too. And look, this is just the first official day of the conference. You were here all weekend.
I was here all weekend.
But the number of people who are here is so much bigger. And Carol, we'd be remiss not to say that last time we were here in October, we had to wear a mask everywhere we went.
Yep, it was a lot more lockdown. It's not. I'm looking around. I don't see anybody.
I'm the only one here who's been wearing a mask.
I was wearing a mask on the weekend, but it's kind of, that's just...
And I think people are so eager to kind of get on with it. And companies are making moves. This panel I keep talking about, this retail panel, the CEO of Lowe's and Kroger and CTO of Wayfair, CEO of Stitch Fix, excuse me. I mean, they're spending on technology. That's a big part. They're worried about making sure they have enough people because that's still important despite increasingly a technology world.
That are available if you don't have the people to fill.
But it's interesting. The CEO of Kroger, what a fascinating guy. And he just talked more about, use of automation. Rodney McMullen, he's the chairman and CEO. and how they partnered with a British company and, picking groceries and, trying to figure out ways, especially amid these labor shortages.
Yeah, how can they do that in a way that increases efficiency, it doesn't cost too much, and also doesn't destroy jobs? Look, much more on Milken coming up in just a couple of minutes. First, though, a check of the latest world and national news. We go to Washington, D.C. for Nancy Lyons. Hey, Nance.
Hey, Tim. President Biden today is honoring 230 members of the Federal Civil Service, resuming another practice that had been discontinued by his predecessor. Bloomberg's Irv Chapman has more on today's award ceremony.
The president spoke of the increased workload brought on by the pandemic, starting with promoting vaccinations.
He restored the faith of millions of Americans in their government, getting checks into people's pockets literally just to keep food on the table, helping communities rebuild in the wake of storms and wildfires, cleaning up the polluted lands and waters, and caring for our veterans.
The president said civil servants would now carry out the infrastructure law as the Energy Department offered $3 billion to support domestic manufacturing of advanced batteries. In Washington, Irv Chapman, Bloomberg Radio.
A special grand jury has been selected in Georgia to investigate whether former President Trump and others illegally tried to influence the 2020 election. Judge Robert McBurney offered instructions to the pool of potential jurors.
You shall give true answers to all questions asked concerning your qualifications to serve as grand jurors.
McBurney told those selected that the grand jury could be seated for up to a year. Efforts to unionize at a second Staten Island Amazon warehouse have failed. Votes are still being tabulated, but ballots cast against the union are enough to fend off a win for the Amazon Labor Union. A separate election held last month at another Staten Island Amazon warehouse gave the union a surprise victory when workers did vote in favor of unionizing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. You're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. We are here at the Milken Institute Global Conference in Beverly Hills. We are on YouTube. We're a little frantic, so be patient with us, everybody watching on YouTube, because
you'll crazy. You'll get a special behind the scenes of what we do when it comes to remotes.
When I make a face, it's not about the guests. It's not about my co-host. It's just
usually it's about some noise that you're hearing in your ear.
I'm not good when I hear myself back.
Or we lost the Wi-Fi.
You've got a panel coming up a little bit later on. Tell me about
it. Social impact as a tailwind, or private capital as a tailwind for social impact. So it's all about private capital being used in the context of ESG.
We talked about this with Steve Klinsky.
We did, and it's really interesting. I got a great group of folks. I got Eric Wilmes, who oversees private equity for North America for Singapore's entire sovereign wealth fund.
Interesting.
Okay, so we're talking some serious capital here.
Right.
I'm talking to two middle market private equity folks who take a really sort of get their hands dirty approach when it comes to the companies that they buy. They buy closely held family companies. They really get in there. They help with the operations there.
Right.
Interestingly enough, Carol, both of these companies in the last year have hired chief sustainability officers or somebody who is in charge of ESG now. And I'm thinking to myself, what the heck has changed in the last few years where you're now hiring people who are essentially cost centers to come in and focus on ESG?
Because of the trillions of dollars that are going into, ESG assets, right?
Yeah.
Investors are demanding it, right? So if you want to attract that money, you've got to make sure you're up to snuff with
exactly.
It comes
so
to
that's
ESG.
something I want to talk about with them, Carol, is where is this shift happening? Is it that LPs are coming in and they're saying, we are pensions, we're university endowments, we need transparency here, we need ESG here, because that's what we need to tell our clients.
I love what Steve Klinsky, though, said about, wanting to do good because, wanting my kids to be proud. And I do think about the shift. I think it's maybe easier for privately held companies to do this potentially than maybe it is for publicly held. I don't know.
Why is that? Because that's something that they say as well.
You and I talk about it when we look at the quarterly metrics.
They don't have to talk about
We don't talk about
the
it.
top line and bottom line.
We don't. But
every
at some point, I think we will, because you're not going to have a choice. You're listening to Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. A reversal for NASDAQ now in the green. S&P well off session lows. The Dow have been down 527 points, now down by 177. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks well off their lows in a choppy session. Dow's paring losses to 173. S&Ps are down 21, and NASDAQ is higher by 34. The U.S. 10 yield at 3%. Gold is down 34. Oil is in the green, and Bitcoin is little changed. Among the main 11 S&P sectors, only telecom, tech, and energy were in the green. And leaders to the upside in the Dow, Intel and Chevron, while American Express fell 3% and led to the downside. In deal news, Reuters said that Elon Musk is in new financing talks for his Twitter deal. In other news, Citigroup's London trading desk was behind today's European flash crash. And wrapping things up, Clorox and Expedia report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal, I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, our next guest and her company invests in private equity, private debt, real assets, and they embed ESG throughout the investment cycle. So great to welcome with us Virginie Mirgon. She is the CEO of Eurasio, and they've got, I think they had about 31 billion of euros, right, at the end of the last year. How are you?
I'm very well. I'm very happy to be here.
Well, it's great to have you here with Tim and myself. Talk to us about the investment environment. How do you see it?
You're laughing. Why are you laughing right now?
Just like that. Okay, well, I am glad I am a private investor. Good luck for the public ones.
What? I mean, it's just... So what's the difference?
You said the tipping point. I think the tipping point has probably started so many years ago, but you're right, it's another one for sure. Volatility is so high. Private is already difficult, but at least you have time to, deliver your investment thesis, your equity story, your extra financial conviction, bring this to the companies, grow it geographically speaking. So you have, you need to deliver returns, both financial and extra financial, but there's less volatility. The question is how much, what's the valuation today compared to what it will be when time is for exit?
Okay, there's less volatility, but the challenges that investors are responding to right now, higher rates, inflation, supply chain concerns, labor concerns, concerns about stagflation and growth, those are all things that hit your portfolio companies.
It might, depends, where you've invested. So we at Eurasio have made a number of very clear choices many years ago. So we have a big chunk of our investment in healthcare. I'm not saying healthcare doesn't face supply chain issues, but the labor in a different manner though, and we've always been facing, difficulty to find the right talent in Europe. But the fundamentals are so strong that you can face a bright future. Think also of energy transition or renewables or green economy, where we've invested more than 4 billion so far of our own portfolio, so it's like 15%. Again, I'm not saying it's out of challenge, but I'm saying it's very strong assets which are being looked for and after by investors across the value chain, and we have a very strong portfolio. We'll continue to build it. So, yes, you're very right. Supply chain, inflation, is it structural? Is it just a very strong spike and it will disappear probably in 23, question mark, raw materials. But if you're a platform investing in tech, in healthcare, in new, consumption type of models and renewables, you're not immediately hardly hit by energy prices. I'm not very much into industrial heavy, thanks God. But at some point, it may, get back to you. It depends on, what we have ahead of us.
Virginie, what's fascinating about the ESG space right now, or alternative energy? And I think we're all looking at it differently because of the Russian war in Ukraine and kind of rethinking globally where energy comes from and how we need to be less dependent on fossil fuels. So what's kind of interesting in terms of the trade and investment space?
I think it's interesting. I mean, remember, out of COVID, there's this big theme about relocalizing healthcare production, from mass to vaccines to be autonomous.
So you don't run into the issue of running out of PPE if there is a pandemic.
Or whatever, right?
Or whatever. I think out of that new crisis that we're facing, it's exactly the point that you've mentioned, which is energy autonomy. So Europe is going to accelerate in terms of investment in renewables. I don't know about the US. I think there might be a decoupling between the US and Europe where we may have to accelerate because that's what we have to do to be more independent from gas.
Right.
It will probably take 5 years rather than 10, so that's a good thing. There's always something good or maybe 10 years more than like 15.
So it's like the pandemic, how it increased like the digitization of the world, right? You're saying the same thing, the
same
rapid.
Thing. The same thing, because it's like a wake-up call.
Yeah.
A tough, difficult, worrying wake-up call, but it is a wake-up call.
I have to go there, Carol.
Go.
I got a panel on ESG later coming up. It's all about private capital and social impact.
Yeah.
And I'm wondering about the differences between the United States and Europe right now when it comes to regulations, transparency that LPs want to see when it comes to general partners.
Okay, so I think Europe started earlier. We have a very disciplined, specific framework called the taxonomy. So if you're a GP, an investment company, if you have Article 9, which are impact, and we have about 4 billion of those, Article 9 classified, you're where you want to be. I mean, at least if you care about impact and ESG. And then if you're Article 8, which is, it means that every investment that you make, there's an ESG due diligence and there is a plan. It's not just a financial plan, it's also an extra financial plan of where do you take those companies from an energy mix or a supply chain or a diversity standpoint. The difference between the US and Europe, gender was the strength in Europe. D&I is now the big thing in the US, probably as a follow-on to BLM.
Right.
And on climate or environment, I think, US is catching up. I'm questioning, where the U.S. is going to go now that oil prices are so high again,
right? And
may divert some of, the good intention that we could see last year.
Yeah, it terrifies me a little bit that we're hearing about drilling again and upping it up. So I wish we had more time. Come back. Virginie, thank you so much.
My pleasure.
Really appreciate it. Virginie,
thank you very much.
Margone, of course, CEO of Eurazeo, joining us here at Milken. And you are listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
And you are listening to Bloomberg Business Week. Well, I want to get to our next guest.
Yeah, we want to. We can't get to him yet. We just have to tease him.
All right.
We're talking Eric Schatzker here. If you've been paying any attention to Milken Global this year, you've seen Eric's name a lot this afternoon and this morning because he had a couple great conversations earlier today. Ken Griffin at Citadel, he had Mark Rowan at Apollo. So we're going to talk to him about that.
First, quickly, Charlie Pellet, take it away.
Right, well, here's what's going on. We're looking at a dramatic reversal for the U.S. stock market. 28 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ, they're all higher right now. At one point, we had the Dow down 527. The Dow is now up 55. S&P holding on to a 12-point gain. We've got NASDAQ now rallying by 140 points, up by 1.1%. Worst level, NASDAQ have been down 132 points. But again, green on the screen. 10-year yield, 2.98%. Gold down 34, drop there of 1.8%. West Texas Intermediate crude up 0.5%, 105.19 a barrel. Citigroup CEO Jane Fraser says Citi, yes, it is getting out of Russia, but has to help its clients there before a complete withdrawal.
You can't exit if you don't have your bank on the ground there. So we've stopped soliciting new business, new clients. We're clearly shrinking down our exposures, our business. We've got number one priority on making sure our people in Ukraine are being looked after. But you're kind of the captain who's the last one off the ship because we can't help other people with their own programs to exit if we're not facilitating them.
And Citigroup shares now up by 1.2%. So again, recapping, what a reversal for the U.S. stock market. S&P now up 14, a gain there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stenovic, live at the Milken Institute Global Conference. And with us is our editor-at-large here at Bloomberg News and also the editorial director of Bloomberg New Economy, the one and only Eric Schatzker.
Hello, hello.
Hello, hello. You've been busy.
Sure, I've been busy, yes. I mean, they put me to work. Let's put it that way.
So let's talk about the conversations. Where do you want to start?
Well, I started this morning with Mark Rowan, who is the CEO of Apollo Global Management, one of the largest managers of alternative assets. The thing that makes Apollo interesting, different from Blackstone, different from Carlyle, different from KKR, peer firms, if you like, is that the overwhelming percentage of its assets is in fixed income. And not just fixed income. You think fixed income, you think bonds, you think loans, publicly traded loans. No, what they do is what we call private credit. In fact, they have what they call a yield business that has $360 billion of private credit in it. And as a result of that, they have a slightly different perspective on the world. They don't get stressed out by days like the one we've seen transpire today in the stock market, where the Dow's down 525 and then it's up 50. They can sleep through that stuff quite easily because they, for the most part, don't manage daily liquidity vehicles.
Right.
And his view is that the correction's not over. He sees what everybody sees, right? He's concerned about inflation. He's concerned about rates. If you were in a daily liquidity vehicle or an individual bond or an individual loan, you'd be more concerned about these things because you have to take that daily hit if the market is weakening. If you're in these vehicles, the funds, for example, vehicles sounds like it's a car. It's a fund, right? Or a product, where you can't cash out immediately. It's actually much easier to sleep at night, both for the managers and for the clients, because you can ride out these storms, right? This is a storm of volatility that we're living through in the market.
Right.
And it's one of the reasons why the mood here at Milken isn't darker, because most of the people here come out of the Mike Milken, Drexel, Burnham Lambert legacy, and they are managers of private equity, private credit. Those are the people who can, for the time being.
We see it with the guests that we talk to in private equity. It's just a very different feel.
They're not stressed.
They aren't stressed as much.
Eric, one of the most fascinating parts about the conversation that you had earlier with Mark Rowan was what he said happens over the next 5 years when it comes to retail investors. And the idea that he thinks that within the next 5 years or 5 years from now, we will see retail investor portfolios 50% made up of alternative investments?
Because, and a lot of this will be fixed income replacement, these vehicles that I've been talking about, because their belief, well, first of all, they're designing products that will appeal to the retail investor. Right now, the retail investor only has access to products that resemble institutional products, and the retail investor's needs are different from the institutional investor's needs. So first, it's about product development, but secondly, it's about the retail investor, particularly at a time like this, waking up to the reality that there's no point paying for public market liquidity if you don't need public market liquidity. This is the same realization that institutional investors like pension funds and endowments came to over the past 30 years, led by the now late David Swensen from Yale, who pioneered the endowment model. If you don't need the money now, why put it into a vehicle that gives you access to liquidity now? It doesn't make sense. You're paying for something you don't need.
So are we going to look back in 10 years from now, maybe even sooner, that we're going to say, okay, this is the tipping point where all of a sudden the private markets, and maybe it's already happened, have really taken over? Like we've seen it even in issuance to some extent, right? In terms of companies going, they don't have to.
So much of the credit creation is happening in private markets now. Yes, it is the evolution of a theme. It's not like a switch flipped and all of a sudden we went from a world of public markets to a world of private markets. As I say, this has been slowly building. It starts with the most sophisticated participants, the Yale endowments, for example, the Harvard endowments, the smart sovereign wealth funds like Norwegian Sovereign Wealth Fund, the Singaporeans, for example.
GIC, they're coming on my panel later.
Yeah, perfect. They figured this stuff out a long time ago. And now the wisdom of that choice is becoming apparent to other people. And this becomes more urgent for them if we're living through a time of high inflation, rising rates, declining equity valuations, widening credit spreads, where you're losing money due to the fact that you're in a public market.
Eric, we only have a minute left, but I want to get to Citadel Securities.
Ken Griffin, yes.
Ken Griffin. Big takeaways from your discussion. I must confess, part of it happened while we were on Bloomberg Radio, so I didn't get to tune in.
Well, I would say this. Ken also says that, well, the sort of the macro headline out of the conversation is that this is the most uncertain period since 2008. And uncertainty doesn't necessarily mean things have a leg to go lower, but it does mean more volatility. Specifically as it concerns Citadel, he said these are the toughest 4 months since 2008. He said, in fact, when we got off the panel, he told me he cracked 3 teeth.
Wow.
Because of the stress?
Yes, because of the stress.
Wow. Huh.
And, like, what an anecdote, right?
Okay, guys, position closed on Bitcoin, as you can see. Okay, we made £1,000. So well done, guys. All of you who decided to trade and with me copy this trade, you made a profit. Okay, let's move on. Well done, all of you guys who made a profit. Let's see what other good opportunity will bring us this bank holiday in United Kingdom. Stay safe, guys.
National News and Nancy Lyons. Hey, Nance.
Thanks, Carol. Some Ukrainians have made it safely out of a steel plant in Mariupol, where they've been holed up for weeks. Mariupol Deputy Mayor Sergei Orlov says about 100 people made it out on buses. But he says the Russians resumed their attack shortly after that evacuation.
Territory shelling and even some sniper works on Ukrainian defenders who helped to evacuate citizens. So it's not easy procedure.
Deputy Mayor Orlov says without breaking the Russian blockade of the city, it will be difficult to evacuate everyone inside the steel factory. A federal jury has convicted a New York Police Department veteran charged with assaulting an officer during the Capitol riot. Retired Officer Thomas Webster is the first January 6th defendant to be convicted on an assault charge. He had argued he was defending himself when he tackled the officer and grabbed his gas mask. European Union ministers are in Brussels to discuss their response to Vladimir Putin's war on Ukraine and his insistence that Russia be paid for gas in rubles. Poland wants a ban on Russian oil and likely an embargo on gas. Habeck, who is Germany's economy minister, says they're on board for a ban on oil. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar along with Tim Stanovic live on Bloomberg Business Week. We are live at the Milken Institute Global Conference. We're going to get back to some of our guests, but fascinating to see the markets just bounce back here. We've now got about a 1% gain in the NASDAQ.
Who would have thought?
Who would have thunk?
Yeah, and look, I think what we just spoke about with Eric Schatzker is really important here. Is the DNA of the Milken Global Conference. This is its 25th year, is in the private markets. And so far today, Carol, and we have many more conversations coming up in the next 90 minutes, but so much of the focus has been on private equity and private capital and the way that private capital is shielded from these day-to-day moves that we see in equity markets, and to the extent that that will make it appeal to a wider swath of investors if those products come out that give it easy access.
So as an investor, here's what I'm going to say. I'm going to say I want a piece of that, right? So I'm looking at my portfolio. So
and the SEC is going to say, ha, 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 ha.
But why?
I don't know.
Well, and this is where we've had conversations about opening up, alternative investments increasingly, allowing the retail investor to tap into that. And how do we do that? Because as Eric just mentioned, and as are some of our guests, if you have a 10-year or 20-year runway, if you start investing in your 20s or 30s, you have that runway, and the opportunity for alpha in some of these alternative investments, why wouldn't you want to tap into it? So I'm looking at what does it mean then for the future of the public markets?
You might not want to tap into it because you've been paying attention to the SEC's chair, Gary Gensler, has been saying in recent months that the fee structure of private
this is
equity
where
at 2 and
we've
20
had conversations
is still
about
something
opening
that
up,
has not adjusted
alternative
despite the
investments
fact that there are many more players here. He said that
allowing the
mutual
retail
funds,
investor to tap into that. And how do we do
public
that?
equity
Because
funds,
as Eric
those
just
costs have come
mentioned,
down
and as are some of our guests, if you have a 10-year or 20-year runway, you start investing. But if you're getting outsized gains at the same time,
that's what the private equity industry would say, right?
Right, and I'm playing a little devil's advocate, but what's happening in terms of the equity markets right now and this volatility, people are seeing a lot of those gains erode. And so I don't know, it's complicated, I think, but remember when junk bonds, here we are at Milken, were considered this new FANG investment, and now it's just the norm.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A choppy session. 13 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ, they're all higher right now. The question the bulls are asking, will these gains hold through the closing bell? S&P up right now by 12 points. That is a gain of 0.3%. The Dow up 49, up by 0.1%. At the worst level, the Dow have been down 527. Big swings. Best level, the Dow have been up by 247 points. Right now, to be clear, we've got the Dow up by 41 points, up 0.1%. 10-year yield, 2.98%. Spot gold down $34 the ounce, down 1.8%, $18.62. While West Texas Intermediate crude is up 0.7%, $105.46 a barrel. Bottom line here, lots of volatility as we race toward the closing bell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
The U.S. Centers for Disease Control and Prevention has long been known as the world's top public health agency. But throughout the pandemic, the CDC has stumbled repeatedly. To be sure, some of the agency's troubles have stemmed from political interference, as well as the inherent challenges of dealing with a new virus. But the CDC also made needless errors, such as distributing faulty COVID tests in the early days of the outbreak. To prevent such mistakes in the future, a thorough review of laboratory operations and improvements to data collection and reporting are needed. Although the CDC lacks the regulatory powers that its counterparts in other countries have, it can still provide crucial data, expertise, and advice to health officials and the public alike. First, though, it needs to rebuild the trust that it had long taken for granted. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OP on Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, let's get to it. Just about 10 minutes left in today's trading session. What a wild ride that we have seen, certainly in the public equity markets. We have bounced off our lows, and we're now looking at gains in all of the three major equity averages. Go figure. So let's see what Doug Sioka has to say, CEO and partner at Kavar Capital Partners. He is joining us once again, where he is based, Leawood, Kansas. So, hey, Doug, great to have you here with Tim and myself. It's funny. We are having so many conversations about the private markets that I almost feel like the public markets are a little bit dated at this point. Tell me how you think about both.
Yes, thank you for having me on. I think the public markets are happy to play a second fill or back seat to the private markets in this environment, that's for sure. And, it's interesting because it's difficult at times without having full disclosure requirement of the private markets outside of deal flow that we see to really understand the valuation. Where in a public market front and center, certainly that's something that is being calibrated on a minute-to-minute basis every trading day. And we would contend, just anecdotally, what we saw throughout last year and the first part of this year, public market valuations are actually far more attractive than private market valuations. That is likely due to change or moderate, right, Carol and Tim, just because of the cost of money going up appreciably.
Interesting. So Doug, give us an idea of the way that clients have access to private markets at Kavar Capital Partners.
Yeah, so that's evolving, right? I think one of the great things about, sophistication of finance and call it alchemy if you like, but, there's a lot of demand for negative correlation. So some of the bigger mutual fund purveyors and ETFs are now bringing to market in products that are accessible on very open, the typical open architecture platforms, access to those types of securities. And sometimes negative correlation, right, is just a function of we don't mark to market. So when the market goes down, we don't know if you otherwise would have. But I do think the aspects of some of the private markets can be brought to be very complementary to a well-balanced portfolio.
All right, so what do we do in this environment, though, if we are in the public markets? How do you play it at this point?
It's really challenging, right? Yeah, so, we're looking for, the different opportunities, right? But one of the beautiful things, right, Carol, about indiscriminate selling, and I can certainly make the case that has happened both sides of the equity and debt continuum, is, it really broadens the alternative set to deploy capital, right? So we are, by and large, putting money to work in both stocks and bonds. And in stocks, we're undeniably shading toward value companies, right? Those with great balance sheets, innovative management, large addressable markets, overwhelmingly emphasizing those with a high-quality earnings stream. And then on the fixed income side of the line, look at high-grade corporate debt. Even municipals, even insured municipals right now are offering bond equivalent yields of over 6% for intermediate duration opportunities, and some bond surrogates like preferred stocks and REITs are priced very compelling right now based upon our analysis.
But are they going to be even more compelling in a few weeks if we start to see the market decline more?
Yeah, that's the rub, right? So inelegantly maybe hedge and try to conserve total percentage allocation, to do that in smaller increments. But, Tim, if you try to think about what the market is pricing in and how far it's looking ahead as it begins to do that current price discounting, right, if we're thinking about just the 2 years as a proxy for the Fed activity, then we know we've already priced in the next, probably 4 half-point and 2 quarter-point moves, which takes us out to January of next year, right? So when you look at, particularly in fixed income, will they get cheaper? Maybe, but they'll also roll down 1 year closer to maturity. If that curve does steepen, or obviously the inverse being flattened, there are different strategies you can then deploy with those proceeds as they come due if you've got that portion of the portfolio structured properly.
Hey, Doug, I want to go back to the public versus private markets. I mean, you guys do invest in alternative assets. Increasingly, are your investors saying, I want more and more and more of the alt world versus the kind of plain vanilla investing that we all think about when it comes to the public markets?
In docile markets, Carol, people tend to want to have activity that's a little bit out of the plain vanilla spectrum, right? When things get volatile, what we tend to see people prioritize is transparency, liquidity, and low cost. Right now, in a very volatile period, people have a much better feeling about knowing what they own and how it's going to be impacted by kind of the primary sources of volatility that we're all contending with. So I think when markets are generally more friendly, the appetite for investors to pursue things that are atypical from a prototypical historical asset allocation become greater.
That's really interesting to hear. Do you anticipate that we're going to see more of an interest? And look, this is where our heads are because we're at Milken right now.
Yeah,
and we just heard from Mark Rowan over at Apollo, who thinks that retail investors will have 50% of their portfolios be in alternatives within the next 5 years.
That's quick.
That's really quick. And that's a big change from today, Doug.
Yeah, I remember years ago, guys, when it was a stat came out that there were more mutual funds than there were stocks. And then recently there have been more ETFs than there are mutual funds and stocks, right? So I think what ends up happening in the public markets is you're getting a lot of redundancy. So you're seeing positive correlation across what you thought was a reasonably well-diversified class of assets, particularly on the equity side, where people would say, no, I should be well protected because I don't have all my eggs in one basket. But the problem is a lot of your baskets own the same eggs. So I do think that's going to become more popular just because it's introducing you to a little more capability to have systemic diversification employed upon the portfolio.
All right, so I'm going to ask you this because our MLive blog, they did a pulse survey and they asked what would be the market soundtrack of the moment. I'm going to tell you the top song among hundreds of responses to the question of that is AC/DC's Highway to Hell. You got a song to describe the market environment, Doug Sioka?
I think that one song that's on the bump coming into this program, Where You Drive Me Crazy, that would be very near the top of my list. And maybe Elvis's Love Me Tender, because that's what it needs right now.
I like it. Love Me Tender. Elon Musk tweeted about that a few weeks ago.
Oh, that's right. The blank Me Tender.
Yeah, because of the potential
blank.
tender offer before, he actually came out and said he was buying Twitter.
I love that. I love it. All right, Doug Sioka, we got to run. Be well. Nice to talk with you. Doug Sioka, of course, of Kavar Capital Partners, joining us here on Bloomberg Business Week. And folks, what a different market than what we've seen for the bulk of the day. Just about 2:45 or so, we saw stocks round the corner, bottom, get off that bottom, and rally. We're not near our best levels of the day, but nonetheless, we are seeing definitely gains across the board when it comes to the equity markets.
Yeah, the NASDAQ up 1.6%. The S&P 500 higher by 0.5 percentage point, and the Dow, Carol, higher by 0.2%.
All right, just got a few minutes left in today's trading session. We're going to talk about the volatility that we've seen in the market and the tone. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Taylor Riggs, Katie Greifeld in for Caroline Hyde. We're counting you down to the closing bells here on this Monday afternoon. And here to take us beyond the bell, it's our global simulcast. Just because you're on the road doesn't mean the simulcast doesn't happen. Carol Massar and Tim Stenovic, we welcome our audiences across Bloomberg Television, Radio, as well as on YouTube. Guys, what have you been watching?
Wow, I'm just walking, just taking a look. Well, sorry, everybody's going by me. We're just keeping a watch on the markets coming off, the equity markets, off their lows of the session. I'm not quite sure why we've seen a turnaround in investor sentiment, but we're not at our highs of the level, but we are green across the board here.
Yeah, at the lows of the day, the S&P 500 is down to 1.7%. At its highs of the day, higher by 0.9%. Equity investors today certainly can't make up their mind about which way they want to send the market.
Yeah, I think it's interesting. We talk about sort of going back into big correction territory here into the S&P 500. We're still there, but we're trying to come off of 11% close, Katie, to maybe just now about 10% off of some of the recent highs of a few months ago. Interesting, I know that we were talking earlier about that further bearish call of 4,800 here from Mike Wilson over at Morgan Stanley. At least for today, some of the enthusiasm comes back into the market.
He did warn about a bear market rally. Maybe we're seeing it today because, man, what a bounce back into the close. All those dip buyers, they came to party.
Yeah, and guys, one thing I was looking at, I don't know how much we've talked about this, but a lot of the technical levels that were breached a little bit earlier this morning, particularly with regards to the support on both the S&P and the NASDAQ, and I wonder how much that factored into some of the bounce that we're seeing into the close.
Yeah, you see that here as we count you down and go to some of the big major averages and some of the big close here. Romaine, I'll try to do my best impression of you, of course, as we wait for settlement and get some of the final numbers. I think for size and scope, it's really important to remember that Friday was one of the worst days that we haven't seen since really the pandemic, September of 2020. We're coming off one of the worst months of April, again on Friday, that we hadn't seen since 2008. And so a little bit today, of course, trying to climb out of it, but it has been a big hole that was April and a big hole, Carol, that we dug into. Just to round out the numbers, you have a Dow up 86 points to close here, up about 0.25%, and S&P up also about 24 points to just over about 0.5%, and in NASDAQ, the big outperformer here, you're closing up about 1.6% or so. And a Russell 2000, Carol, when we think about the big reflation, inflationary theme that is underway, those small cap stocks still managing to close up about 1% on the day.
Well, and you mentioned what's going on with the NASDAQ 100. We've had almost a 3% swing from peak to trough when it comes to technology stocks overall. And I find it interesting, Katie, that here we are in a higher rate environment, yet we saw the tech stocks and the NASDAQ rally. That just doesn't make sense to me. It seems a little illogical.
It is fascinating, Carol. Pretty unintuitive. Again, talking about the 3% Treasury yield. To see tech really leading the rebound, who knows? But in any case, if you look under the surface at the sector level, it's interesting to see what actually is driving some of the movement today. Right up at the top, it's a great day for chips. You have semis leading the way, up nearly 4%. You also have auto and components up there. And too, energy and financials maybe as yields rise. But at the bottom of the pack, it's real estate, it's food and beverage, it's household products. We are in earnings season. Inflation is front and center, and you can see that in the sector breakdown as well, Taylor.
Yeah, I'm really glad that you mentioned yields. I know for our radio audience, typically they're probably all confused. We usually go to the winners and the losers on the equity market basis. But you guys, there was so much movement in the bond market that's exactly where I had to go next. And Romaine, I think what is stunning to me is you have a 5-year at a 301, a 10-year at a 299, and a 30-year at a 305. So when you think about some of the flatness across the curve, it's really all right around that 3% level, at least on an intraday basis. The 10-year yield sort of topped that, really sort of highlighting sort of these key technical levels as we head into the big meeting on Wednesday.
Yeah, I don't think we can sort of forget about, of course, the big meeting that starts on Tuesday. And not only the announcement, but really the communication that we're going to get out of that press conference on Wednesday, particularly when you see what yields have already done in the open market, particularly when you see the sell-off that we've had, at least up through Friday in the equity market, and whether maybe some of the heavy lifting has been done, and that gives Powell maybe a little bit more cover to be a little bit less aggressive than what the market had been fretting about.
That big Fed meeting to the Friday jobs report, and I'm curious to see what we see in terms of labor strength. Does that continue? I mean, when I talk to all of the CEOs today, one of the big things, one of the major concerns again is about talent. It's all about that and finding and making sure that you've got the people you need to do what they, to keep kind of the businesses going.
Yeah, Carol, you're getting ahead of me because I'm still thinking about the Fed and what happens on Wednesday and what we do hear from Fed Chair Jay Powell and to what extent the Fed has been looking at the volatility in the markets over the last month to determine what they're going to do next when it comes to interest rates, when it comes to the balance sheet, and then also just the way that they're going to communicate things. Because, look, I think this market does expect an aggressive Fed, but what happens if they get a less aggressive Jay Powell on Wednesday? You
know, Tim, I think it's interesting when you talk about sort of the communication. We continue to get communication from companies and the CEOs of those companies as we get another big week of some of the quarterly results. I want to bring you Expedia as we think about the big reopening trade and where
Oh, Taylor, I think we're having a problem with your mic, but we are looking at Expedia. It looks like the 1Q revenue did match estimates that came in at $2.25 billion. The estimate, again, was $2.25 billion. They did have the 1 quarter adjusted loss per share of 47 cents. The expected loss per share had been 43 cents, so a bit of a disappointment there. And if we look at the shares after hours, they're actually up a little bit, Romaine, up almost 5% at this moment. So clearly traders are parsing through this.
Yeah, parsing through this, and really, I mean, the travel story is going to be a really interesting one heading deeper into the year. Remember, there are a lot of folks that already say that we actually saw the travel rebound already. Remember, a lot of folks, particularly in some of those states that weren't sort of under as many restrictions, had already been out there flying and booking hotels, at least domestically here. We've started to receive the return of international travel, and now the really big question is, when do we see a full return of some of that business travel? If that does come back in focus, I think maybe you'll see some of these companies right-size themselves. I can tell you, at least here on the ground, out at the Milken Conference here, international travel certainly picking back up.
I'm back, Romaine. I think the mic gods were mad that I cut you off. I thought it was just payback for all the times you cut me off, but my microphone is working as we continue to trickle through some of these quarterly earnings
results. Let's make sure it keeps working for Taylor.
Katie never interrupts me, Romaine. Never. Wouldn't dream of it.
It's loud here, so if I keep interrupting you, just, forgive me.
Well, let me talk really loudly right now because we do have some more earnings. Avis out with some huge numbers. I had to double check this, but if we look at the 1 quarter adjusted EPS, it was $9.99 a share. The estimate was for $3.26 a share. That is quite a beat. 1 quarter net revenue was $2.43 billion. The estimate, again, for $2.17 billion. And these shares are absolutely soaring after hours, up 11.6%. And coming into today, these shares were already up 35% year to date for Avis. Just some really huge numbers there.
Yeah, that's one of those headline crossers when it comes to Avis that you're like, wait, is that right? But that is a huge outperformance, and at least initially investors are reacting. I'm just going to go back to a big macro. Eric Schatzker was just joining us, and he talked about his conversation with Ken Griffin over at Citadel, and he said, period of highest uncertainty since 2008. Something like that, when I hear it, it makes me stop and just feel like we are in this really odd environment.
Well, it's so interesting, Carol. If he says that he's uncertain and he's seeing uncertainty, it's not necessarily the same thing that we're seeing from companies or hearing from companies about the strength of the American consumer. I mean, look at Avis just now. Ticker CAR, with the beat on the top line and the bottom line, obviously has some pricing power there, and obviously is seeing huge demand for travel. It reminds me of my conversation just a couple of weeks ago with Jefferies analyst Sheila Kayalu, who says that consumers are certainly shelling out for higher airfares, but they're also can't forget about the other costs that are going up when they do get to their destination if they're leisure travelers. The car rentals, the lattes that they get, the hotel rooms, and how is that going to eat into their spending power?
Yeah, inflation. It's basically been all the talk here. I think what's interesting, though, is how many folks you speak to who say that inflation, while a concern, not necessarily an impediment, at least to them making money, and more importantly, I guess some of the opportunities out there that actually present themselves in a slightly less robust economy, particularly for those folks in the credit space.
And it does seem to be sort of a takeaway from the earnings season that we have seen thus far, especially from some of the retail names, that maybe we haven't reached the point where we start to see demand destruction, where when we think about all of these costs, these rising input costs, what's being passed on to the consumer, again, the consumer is miserable, but we're still spending money.
We heard that from Poonam Goyal, of course, getting her reaction when it comes to Amazon pushing his forward curl to Etsy, right, and some of the other Shopify. As you think about some of these other big consumer names, Expedia coming out and saying Omicron in the beginning of the year has totally faded. Huge demand has reached new highs since the start of COVID. So at least you're right, for now, consumers still spending in the face of that inflation.
And yet Amazon talking about that overspend of facilities and more amid some pullback when it comes to e-commerce. So something we're going to be watching. All right, folks, that's going to do it for our cross-platform coverage on radio, TV, and YouTube. We are counting you down to the close, of course, on this Monday. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic.
Here we are.
I feel a little shell-shocked.
I do too, and well, I'm shell-shocked for a couple of reasons. One, it's only 1 o'clock here in California, and usually the market's closed for us at 4 o'clock, and we're still in New York time, but everyone else around us is
that why I woke up at
California
3:30
time.
this morning?
That is exactly why you woke up at 3:30 this morning. So that's part of it. The other part, of course, is I think too, Carol. I'm going to sound like a broken record here, but the focus of today for a lot of our guests and for us has been on the private markets. And we talked to these private equity folks about the volatility that we've seen in the equity market this year. And literally, we're met with laughter.
Yeah.
We're met with laughter.
We're not worried about it.
Yeah.
Right?
Yeah.
I mean, it's crazy. Anyway, we're going to continue with this. First up, though, let's get back to world and national news and a check-in with Nancy Lyons. Hey, Nance.
Thanks, Carol. U.S. officials have been providing an update on Russia's invasion of Ukraine, with the U.S. representative to the Organization for Security and Cooperation in Europe, Ambassador Michael Carpenter, saying that Vladimir Putin's troops are scaling back their targets.
What we are seeing right now is that Russia's forces are regrouping and refocusing their effort on Ukraine's south and east.
Carpenter says they are also receiving word that Ukrainian officials are being abducted and that Russia's then bringing in ringers to take over local governments in the eastern portion of Ukraine. Help for the U.S. semiconductor industry may be on the way as lawmakers launch into a days-long debate over competitiveness with China. Bloomberg's Amy Morris has more from Washington.
Senate Majority Leader Chuck Schumer has set aside tomorrow and Wednesday for lawmakers to consider the legislation, which promises more than $50 billion to expand U.S. semiconductor manufacturing capacity. House Speaker Nancy Pelosi says they hope to start reconciling the bills by the end of the week. Schumer says the instructions are the most seen on any bill in decades, and while it's time-consuming, it shows that semiconductor funding remains a bipartisan priority. In Washington, I'm Amy Morris, Bloomberg Radio.
The House Select Committee investigating the January 6th assault on the Capitol is asking 3 additional Republican congressmen to testify about what they knew regarding events leading up to the riot. Chairman Benny Thompson is asking Congressman Mo Brooks, Andy Biggs, and Ronnie Jackson to cooperate with the committee. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. So, we love our Markets Live blog, and our whole team, Vince Signorella, everybody, right, they're contributing to that blog. And they apparently did an MLive pulse survey, Markets Live pulse survey.
We love data here at Bloomberg.
We do. But what they asked, really important market question. If there were a market soundtrack at the moment, what would it be?
Okay.
So go ahead.
Okay, so here's what they said. Highway to Hell is by AC/DC is the ageless anthem, of course. It was the top song among hundreds of responses to the question of which rock or pop song most perfectly encapsulates this year's Fed monetary policy in that latest MLive Pulse survey. There were a lot of runners-up, though.
Yeah, a lot of vintage themes dominating. Dozens of call-outs.
This is hilarious.
For Queen's We Will Rock You.
Yeah, feeling like they're getting rocked by the FOMC. Okay.
Bon Jovi is Living on a Prayer.
Okay, that one's a good one.
And Under Pressure, also by Queen with David Bowie. Under Pressure.
Okay, I don't know if we have the rights to it, Carol, so you got to be careful.
sorry.
Frustration ruled as well, with multiple mentions of the Rolling Stones. You can't always get what you want, and Satisfaction. And then this is a fun one about the end of the world, Carol.
It's the end of the world as we know it.
That's, of course, R.E.M., or Carol Masters singing R.E.M.
Yeah, sorry about that, everybody.
That one among the most, in terms of responses to the MLive Pulse survey. How come I didn't get surveyed?
I don't know. What's up with that? Britney Spears, also on investors' minds with Hit Me Baby One More Time. And oops, I did it again.
I think the Hit Me Baby One More Time I get, but...
Oops, I did it again.
What
I
do-
don't know. I don't know. Market selling
We'll have to
off.
see.
Markets, right?
Or maybe the, Fed raising interest
Oh,
rates.
right. Oh, yeah. Oh, because
Yeah.
this is about the Fed.
Yeah, it's about the FOMC.
I'm thinking about the markets.
Yeah.
Well, the Fed is a poor substitute for your love. Jackie Wilson's Higher and Higher was also cited. Going way back, great song. Seems appropriate with yields on 10-year treasuries hitting more than a 3-year high of 3% as investors do brace for the biggest interest rate hike since 2000. See, this is why we love our Markets Live blog, because we're doing songs and they bring it back to the markets.
Charlie Pellet says that Upside Down, Inside Out is what he would voted for.
Nice done, Pellet.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A major reversal for the U.S. stock market today. Dip buyers saving the day. Stocks finished higher. S&P up 23, a gain of 0.6%. At one point, the S&P had been down 1.7%. The Dow had a loss at one point of 527 points. The Dow ended higher today by 84 points, up 0.3%. NASDAQ up 201, a gain for NASDAQ of 1.6%. Dip buyers emerged after the worst month for the S&P 500 since the onset of the pandemic. 10-year yield 2.98%. Treasury 10-year yields did trade near 3% today. Spot gold down 35, a drop of 1.9%, 18.61 the ounce. West Texas Intermediate crude up 0.7, 105.38 a barrel. Earnings news: Avis Budget shares are rallying after hours, up by about 12%. It reported adjusted earnings per share for the first quarter that beat the average analyst estimate. And Expedia shares up about 4% in extended trading after the online travel agency reported its first quarter results. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I am so looking forward to talking with our next guest. With us is Purnima Puri, Managing Director, Portfolio Manager for the Public Credit Strategies at HPS Partners. They've got $25 billion in public credit, $56 billion in private credit. You know what it is when it comes to credit. How are you?
I'm good. How are you?
I'm okay. So we were talking a bunch here before we got going. When you look at the environment right now, it just feels, of another volatile day on Wall Street. We talked to the private markets people, and they're like, yeah, we're okay. We're doing. They're not so stressed out. How do you see it right now?
So I think there's a bunch of sort of things that are going on. One is that this is the first environment where you've had upwardly trending rates. You have upwardly trending inflation, and you actually don't have all the central banks moving in tandem. So you have a lot of things that are going on that we haven't seen in the last 20 plus years.
Yeah.
Or certainly in my investment career, I haven't seen that. And so, I think people are trying to figure out both sort of how to allocate money and where to hide until things kind of settle down, and volatility likely will settle down once we get to kind of a resting place on rates.
But until we get there, don't you see opportunities?
I'm not sure I see opportunities until we get there, because I think what's happened so far, and I think we're getting close, by the way, but credit spreads haven't moved out so much. I mean, if you look at credit spreads across the spectrum, investment grade sort of 160 over. Post-GFC, investment grade spreads toggled between 100 basis points on the tight side and 260 on the wide. So we're right there at the median, 58% of the, percentile. High yield is sort of based on any given numbers. You can look at a whole bunch of different ranges, 430, 440, 450 over. The median is like 5 to 550. Levered loans are 450 over. Again, the median's been north of 500. And we're in a little bit of a riskier environment. So I actually don't think you've seen credit spreads move. You've seen treasuries move. Treasuries have been a dramatic move. The 10-year's down 11% this year. Equity market's down 13%. So the credit spread, let me say it differently. The returns have been primarily based on what's happened in the treasury market. But if you get to a 3.5% treasury, which looks like we might get there, and all of a sudden you can make 5.5%, 6% for investment grade, that's not so bad, actually.
Well, so is that the perspective we need to think about? It's not like we're back to the 70s, right, in terms of some of the rate environment. So I'm just curious, what is the smart perspective to have as we see rates normalize, right? Which they should. We should want them to.
Yeah, we should want them to. And we're getting there, right? You kind of want it to happen. Let's take the pain and move on.
Right.
So I think our view is that, rates will continue to go, and I don't know if you get to 3.25% or 3.5%, but we're kind of getting close now.
Right.
So I think that's one. I think two is that you will see credit spreads widen. I think, we can look at all these different variables, but on any given measure, if IG is at 55 to 60th percentile and high yield and loans are inside of 50% based on different metrics, we're not there yet. And the risk has not really been priced into the market. But I think you will see it, and I think at that moment in time, there'll be an opportunity in the credit space that we haven't seen, right? Because we've been in zero rates for so long.
So are you anticipating higher corporate credit defaults? Are we going to see that play out?
So we got asked this question earlier. I think there's two different things that are going on. In order to have defaults, you need maturities.
Okay.
And it turns out we don't have a lot of maturities in the loan market and the high yield market, between now and 2024.
Right.
So I actually don't think you're going to have a number of defaults. I think what you are going to have, and this has been a sort of mega trend, if you will, in the credit markets, and this is a little bit myopic because we're talking about levered credit for a second, but the trend that you've seen has been documentation and taking really a lot of advantage of what is available to kick the can. So what does that actually mean? It means, can I move an asset away from a creditor group? Can I finance something in a different spot? Can I dividend money out? All that kind of stuff that's happening. And I think there has been increasing comfort to do that, which we hadn't seen historically by sponsors. And by the way, those guys, they're fiduciaries too, and they negotiated the stocks. So, so they should do that if they want to do that. But I do think what that means is you may not have a default cycle. You might have to look at risk differently in that there might be lots of exchange offerings and ways for companies to live longer. And so trading prices will represent risk, but it may not correlate with actual defaults.
Right, so you have to look at different factors.
I think so.
Okay.
I can't believe we haven't talked about Elon Musk.
Yeah, you want to talk about Elon Musk?
I want to talk a little bit about Elon Musk. What do you make of his plan to just take things private, to take Twitter private right now?
What do I make of his
Is the LBO back?
Well, the mega deal is back. That's for sure, right? The mega deal is back.
Yeah.
I don't have a strong perspective on Elon Musk and
It is
Twitter.
interesting. Well, it is interesting seeing an individual come out, make such a huge buy.
Or the structure of the deal.
And the structure of the deal.
Yeah, it is. And again, we're seeing these different structures take place all over the place now, right? So, but I don't have a strong perspective on Elon Musk and the LBO.
All right, I'm guessing, though, you do have a strong perspective because you did a panel on inflation. So tell us a little bit about, it's I don't know, should we assume it's just going to run at a higher rate? And that is, this is what the Fed's trying to figure out, right?
Yeah. So I would say a couple things. I think one is I do think inflation is stickier. So I think that is true. I think inflation related to China and inflation related to the war are two different things.
Okay.
I think that the inflation reads we're getting suggest that, roughly half of those spikes are related to the supply chain problem. So if that abates, which you're seeing signs of it now, when you see corporate earnings come out, you're seeing sort of some Ford, GM, they're starting to see a little bit of that abating, right? So I think the one question is, what are we going to see with goods inflation? And then question two is, what's stickier more broadly as a result of the war?
20 seconds.
Okay. There are a lot of trends that are inflationary. ESG is inflationary. Deglobalization is inflationary. And aging population is inflationary. So we do think it'll be stickier, and we think you will continue to see a trend.
Love that. Don't love it in terms of how it plays out, but it makes sense. Purnima Puri, she is Managing Director over at HPS Partners.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed, you are listening to Bloomberg Business Week. Carol Massar, along with Tim Stanovic, got a great guest coming up. The founder and CEO of Oak Hill Advisors, Glenn August, will be with us in just a moment. First up, though, back to Charlie Pellet.
Yeah, thank you very much. Turned out to be an up day for the Dow, the S&P, and NASDAQ, but first, earnings. Plenty of them after the close of trading. Clorox lowered its outlook for full-year earnings amid stubbornly rising costs. Shares down now by about 4.1%. Clorox is the maker of Pine Sol and Glad trash bags. Avis Budget reported adjusted EPS for the first quarter that beat the average analyst estimate. After hours, Avis Budget shares, they're up now in the fast lane by about 11%. Expedia shares up 4.5% after the online travel agency reported its first quarter results. The travel booking company said it does see positive indicators for a strong recovery in leisure travel. Stocks closed higher. What a wild session to kick off the trading month of May. This is a week that is likely to be marked by unnerving market gyrations, with the Fed expected to deliver its biggest rate hike in 2 decades on Wednesday. S&P had been down 69, ended with a gain of 23 points, up 0.6%. The Dow up 84, higher by 0.3%. At one point, by the way, the Dow was down 527. NASDAQ up 201, a gain there of 1.6%. 10-year yield now 2.97%. Spot gold down $34 the ounce, down 1.8%. West Texas Intermediate crude up 0.5, 105.27 a barrel. Well, as for where to commit capital in this volatile market, Doug Sioka is CEO of Kavar Capital. He was our guest right here on Bloomberg Business Week.
We are, by and large, putting money to work in both stocks and bonds. And in stocks, we're undeniably shading toward value companies, right? Those with great balance sheets, innovative management, large addressable markets, overwhelmingly emphasizing those with a high-quality earnings stream.
And again, recapping, turned out to be an up-day volatile session. Dip buyers came in the final hour or so. S&P ended with a gain of 23 points, up 0.6. The 10-year yield, 2.97%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Well, our next guest is taking over my Bloomberg terminal here at Milken. Glenn August is with us, founder and CEO of the alt investment firm Oak Hill Advisors. So nice to have you here. How are you?
I'm doing great. Nice to be here.
Good to have you here. When you look at the macro environment, you've probably been asked about it a million times. How do you see it?
Well, look, we are digesting inflation. It's real. It's getting more real. But the Fed is going to act, and the markets already have discounted a lot of it. Everyone's like, "Oh, Bill, no, the Fed's going to keep on going. Fed's going to keep on going." But the 5 years at 3%. Mm-hmm. And
is that the top?
I don't know if it's the top, but I believe that the market is discounted a lot. And now we don't know. The Fed's going to act, and whether it's 200 basis points in the next 12 months or more, we're going to see what inflation really ends up being. Now, look, I happen to think inflation is going to be a little higher, and I do think the Fed has the resolve to basically choke it off. So we may need to go higher, but I think there's probably a little consolidation here.
Are you concerned, though, that inflation could get out of control?
What is out of control? The ingredients of inflation are labor, supply chain, and commodities today. And I think commodity inflation has seen the bulk of it. I happen to think commodity prices, energy prices are going to stay higher for longer, because I think there's structural issues and structural underinvestment in energy. I think labor, there's still a lot of pressure, but I think we may see some signs of reduced pressure, or at least change of growth. And so I don't know. I think that we will see real inflation, and it'll be high, but I don't know if this is out of control inflation. The supply chain, I think it'll take a year to make those adjustments, and the geopolitical backdrop and what happens in China is going to drive a lot of that stuff too. So I feel like rates have gone up meaningfully. I think a lot of that is in the market. And I think stocks have responded appropriately. I mean, when rates go up that much, it's going to move equity markets, especially growth stocks.
Glenn, what do you see on the distressed front?
Look, it's interesting. I always say, be careful what you wish for. There's not a lot of distress today.
Yeah.
There really isn't.
Right.
I mean, the default ratio,
I think we're
distress ratio.
shocked that we didn't see more coming out
But
of the
you know,
pandemic.
but there's distress when there is a recession, and we're not at a point of recession. We had so much stimulus. There was so much rescue finance. There was extraordinary opportunities in 2020 and 2021. We had some of our best years ever. But there's not that much distress, and even if equities sell off 10, 15, 20%, there's still substantial cushion in leverage finance that you don't have defaults anytime soon. And so I will say that there's probably more distress possibility in Europe because I think the Europeans are in a tougher position for navigating long-term structural commodity price increases. They have less of labor increases because they still have more slack in the economy, but I think they're more exposed there. I think the credits are a little tighter, a little smaller, or a little less diversified.
Similar to what we heard from Jane Fraser earlier today in her interview with our Bloomberg colleague, saying that she is more concerned about the European consumer than the American consumer.
Look, I will tell you, I am involved in a company, and a very
Connection
senior guy who's a very senior German executive is talking about buying supplies to go into hiding if there's a war in Germany. And the combination of the anxiety that we don't necessarily feel here today in the U.S., coupled with the inflation risks in Europe, it really is changing the psyche in Europe. And I do think that Europe has more exposure. Again, that may seem so dramatic.
What's on his doorstep? Right?
Well, look around the corner. Exactly right. Yeah. And so, again, we don't feel that in the U.S. today. But I will tell you that when Germany changes its defense policy, it starts spending a lot of money. So anyway, that's the headline there.
So when it comes to major structural stories, we were just talking with our previous guests about just the change in energy, right? And the move towards energy, the aging of so many populations in various countries. I mean, there's just kind of a recalibration in coming out of the pandemic. What do you think are kind of those big macro that you think investors generally need to understand that these are longer term trends?
Look, I think that absorbing the changing energy environment is certainly one of those, and I do think there is a sense that maybe the desire for ESG, which we are all incredibly supportive of, and sustainability, and I can't tell you how much my firm spends on investing in sustainability. At the same time, energy security has been uncovered through this whole Russian-Ukrainian crisis, and so I do think that how do we find longer-term solutions? That's certainly one of the major trends. Again, I think cyber, when I think about distress, by the way, and I think, how does distress happen? So if there's a recession, distress happens. If geopolitical gets materially worse, and there's some sobering comments that are being made here at the conference that we may see a worsening and potentially a tactical nuclear weapon, which, again, would be material to the markets. Cyber is one of those things that hangs out there that could be massively destabilizing. And I look at the last year, and it's actually ironic being here at the Milken conference, because when I was in Milken in Abu Dhabi, and basically I was talking about the COVID virus, I was less concerned about that. I was more concerned about the virus of cyber.
Yeah.
And you see, Southeastern utilities get shut down for $5 million ransom. I mean, that is dangerous stuff, and that could, I think, create some trends, some issues.
I wish we had more time, but thank you so much for the time you gave us. Really appreciate it. Glenn August, of course, of Oak Hill Advisors. All right, we're going to toss it over to Nancy Lyons in D.C. Thanks.
Thanks, Carol. The White House says reports of Finland applying to join NATO and the question more broadly of the alliance growing larger shows the unity across Europe and North America. White House Press Secretary Jen Psaki.
The president supports the open door policy of NATO and supports those who have aspirations to join to apply for membership.
Psaki noted Russian President Vladimir Putin's objectives to divide NATO have backfired, and the exact opposite is occurring. Most Americans are still showing firm support for Ukraine. Bloomberg's Nathan Hager has more from Washington.
A new Washington Post ABC News poll finds 73% think the U.S. is either doing the right amount or not enough for Ukraine. At the same time, 72% still oppose direct U.S. military action against Russia. 2 in 3 Americans say they're concerned about sanctions adding to inflation. Despite that, 2/3 are in favor of increasing them. The poll also gives President Biden a 42% overall job approval rating. That's up from 37% in February. 42% also favor his handling of Ukraine and Russia. 47% disapprove. In Washington, I'm Nathan Hager, Bloomberg Radio.
A federal jury has convicted a New York Police Department veteran of assaulting an officer during the U.S. Capitol riot, rejecting his claim he was defending himself when he tackled the officer and grabbed his gas mask. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic here at the Milken Institute Global Conference in Beverly Hills. You know, you and I are just talking, and it's just, it's fascinating, like I said, over and over, talking to those in the private equity space. And this is what Milken is all about in a large ways versus the public markets. But calm understanding that maybe there's going to be some turmoil, but they kind of almost have, you know, a lot of tools that gives them some leeway, if you will, versus those companies that play in the public market space.
I'm grinning because I'm just thinking time
you've got a
horizon,
panel coming
time
up.
horizon, time horizon, right? These
Right.
are private equity
Stark.
investment, you know, 2, 5, 10 years.
Right.
That's where the capital is locked up.
Or
before
10
there's an
years in
exit.
some case, like we heard from some of our guests.
Yeah, exactly. So, okay, but there is this idea, Carol, that there could be opportunities down the line. And there is still, we heard this from Carlisle's Q Song Lee about that he said in the first quarter, deals dried up.
Right.
So
they don't have anything to play with, right?
That wasn't what we heard from everyone.
No, exactly. So it's making me think about this market environment. I still think about Ken Griffin saying, you know, what toughest environment since 2008 in terms of the level of uncertainty. And I do feel like in conversations that I think people feel like consumers are still out spending, their balance sheets have still been okay, but what happens is those balance sheets start to come undone. And I think the labor market's going to be really important. If we start to see some weakness or slow down, I think that will be very important.
It's interesting because I don't think we get the idea that the consumer has the same anxiety that somebody like Ken Griffin has. It's not,
Does or doesn't?
Does not. The consumer absolutely
Do you
does
feel
not.
that way against all consumers?
Yeah, despite the fact that what consumers are saying in terms of consumer sentiment responses,
yeah,
what they're doing. And the way that, I mean, look, you had a panel about retail spending.
They're shopping.
They're shopping. They're spending money.
Yeah,
they're not holding back.
And they may be doing it differently. They may be not buying so much, or they're buying quality
Yeah.
and spending more in terms of an individual bag. But I don't know. It is an interesting environment. All right, we're going to continue in just a moment right here on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lots of after-the-bell earnings. Clorox shares are falling after cutting its annual profit view on inflation. Avis Budget is reporting EPS for the first quarter that beat the average analyst estimate, and Expedia is reporting revenue in the first quarter that jumped 80%. That was in line, though, with analyst estimates. It signaled that strong summer demand is ahead after 2 years of pent-up demand. We've got Expedia up now by 2%. Stocks rebounded with the S&P ending the day with a gain of 23 points, up by about 0.6%. The Dow up 84, up by 0.3. NASDAQ up 201, up 1.6%. 10-year yield 2.96%. Spot gold down $34 the ounce, down 1.8%. West Texas Intermediate crude up 0.4%, 105.13 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So a great way to wrap up our first day at Milk. And joining us is Mark Adenazio. He is co-founder, managing partner of Crescent Capital Group. He's chairman, principal owner of the Milwaukee Brewers. How are you?
Well, it's really great to be back in a big gathering. I was here in October when it seemed like half the size. So
and we all had to wear masks everywhere.
It's a different tone.
And they had the mask police walking around. And people come up and stare at you and glare, right?
Well, hopefully we're all feeling pretty good about it in 7 days.
All right, so what's more fun to talk about? The credit markets, the debt markets, the credit cycle, or to talk about your team?
Well, that depends on how the team's doing, and since we're in first place,
you're doing really well.
There.
You're doing really well.
That's certainly.
Is it an
fun.
easier call about the outlook in terms of the season versus the markets right now?
Yeah. Well, I think the season always depends on your health. So that's
true.
And I think with the markets, it depends on the health of the economy for the most part. A lot of the talk with interest rates and inflation. To me, and I know that as a private investor, we get to look, beyond quarter to quarter. There's a lot of noise in that.
Yeah.
So, for example, and somebody asked me this morning and caught me a little off guard in our group. How many interest rate hikes have there been so far?
This year?
So far.
1.
Exactly. So I said, I'm like 2. He said, no, 1. I said, oh, yeah, this week will be 2.
Supposedly.
I'm looking ahead.
Some people think 3.
I'm looking ahead. Yeah, right.
Well, you bring up a really good point, and we have been talking to a lot. It's Milk, and so we're talking a lot of private market stuff, a lot of private capital, a lot of private equity. Still, though, the macro environment matters to you. It matters a lot. Are we going to enter a prolonged period of inflation?
The macro, that is a big change. Mark Rowan this morning talked about how take everything learned before 2008 and discard it. I'm not sure that's entirely true, certainly as a credit investor. But I would say a lot of what we used to, think is, in our little corner of the world, if a company had good numbers in 1985 when I worked for Mike, for Milken.
Yeah.
As he often says, there were 10,000 who say they worked for him. 100 of us actually did work directly for him. You look at that company, and you didn't worry about whether China was going to have an accommodative credit policy and fiscal policy, and that maybe that would spur global growth, and which would then help us now looking forward. So yeah, now you have to look at everything with the one world, and there's a lot of reasons to have inflation, starting with energy prices and cost of food, and especially in Europe. So that all sort of ripples through. Interest rates tend to work their magic in both directions.
Right.
And so this morning, for example, kind of I focus only on corporate credit really, but 30-year mortgage at 5.5%. At some point, people are going to stop buying houses, right? Because most folks who buy houses are trying to lock in a 30-year mortgage.
So we'll see some relief in the housing market. We'll see that inflation come down.
You would think so, although the question is when, right? So and one of the things I said before I went on with Romaine is, he said, "Were you learning anything?" Yeah, well, everybody's talking their book, and I kind of know everybody's book. So the real estate investors are going to say, "Oh, inflation is great for housing prices. Next 2 years," and they're all saying next 2 years in real estate are going to be good for them. And it may be, and especially in markets like California where there's usually a lag anyway. So we'll see when all this comes to bear, and there may be some some offsetting moves by the Fed, and also, in Europe with fiscal policy, and we talked about China, that, it's going to be a little bit of an ebb and flow, I think.
So where's the opportunity for you, or how much more difficult is it?
This is always, I remember I was in a credit committee in my old firm before we spun Crescent out of TCW in 2007.
Right.
And all of the assembled geniuses, including me, and that's the tongue-in-cheek, were
Noted.
The idea was sunny sky. I remember very clearly, bright sunshine, no clouds anywhere. This was in June of 2007.
Yeah, nothing was going to happen.
Wrong.
Right, exactly, wrong. So, I talked about it being the golden age of private credit when I was on Bloomberg in October.
Yeah.
And there's still a huge amount of reason to see that. There's $2 trillion of dry powder in private equity. You're going to need a multiple of that to finance.
Right.
We only have a fraction of that set up now in private credit, so the supply-demand characteristics are terrific. You have floating rates, so as rates go up, our investors' yields and returns go up. We don't, you mark quarterly, you don't mark daily, so that's favorable.
Right.
In any event, it's going to keep ratcheting up. And, frankly, to this point, you have only good news through quarter end. We have 200 private companies in our portfolio. Virtually everyone is reporting year-over-year, gains, some as high as 50% EBITDA year-over-year.
Are they as positive about the next year?
So far, they are passing on, for the most case, inflationary costs in terms of price increases. They have learned how to handle supply chain disruption.
Yeah.
And they're still struggling with employment and labor costs. So that's, but if you can run sensitivity analysis when you're lending at 4 to 6 times, and somebody's paying 12 to 20 times for a company, and you have a huge amount of cash flow coverage, even with, interest rates spike, call it 3%, 300 basis points, and economic, I should say, company by company downturn in cash flow of 20%, we still have plenty of interest coverage.
Wow.
So so then the question is, well, what could go wrong? What we have to do as investors is, look around the corner and see where, what's lurking. And
so what could go wrong?
That's my question. What is lurking there?
And it's not
skies are sunny now, but
it's not maybe the same for every company, right? In terms of industries, but what could go on a macro level wrong?
Well, obviously the situation in Ukraine is very troubling, right? And you have an errant missile, which worries me.
Yeah.
Doesn't have to even be a nuclear one. It could just be a missile that lands in an adjacent country, and you have issues. And that's probably my number one concern, because that's completely exogenous, out of anybody's hands. And like right now, if you look at our business, which, for example, just looking at what we do and not what a stock picker would look at, we have exactly, I think, one company out of those 200 that has a data center in the Ukraine, and most of our European investments are in developed countries, obviously, almost in fact all are,
right,
in the U.S. So there's not that, and I think that some of the challenge in the world is it feels like it's over there.
I agree.
Right, and it's not affecting us. I mean,
but if you're Germany or another European country, yeah,
right.
It is funny it's not funny, but it's odd to be here, right, and feeling like, okay, everything's okay. Yet if you were over there, you would feel very, very differently.
Yeah, and you've had this bifurcation in terms of wealth. Wealth creation has been astronomical, maybe the greatest it's been in history.
Yeah.
We talk about rising house prices and all that, but there's acute housing shortages, and people who need to have a decent place to live can't afford to buy a house. That's a big problem.
It's a huge problem. I wish we had more time, but I hope we can maybe catch up with you at another point.
Anytime. Great. Hopefully we'll still be in first place.
I was going to say, fingers crossed for you. Mark Adenazio, thank you so much. Really appreciate it. That's going to do it for our first day here at Milken. For Tim Stanovic, I'm Carol Masser. You have a good and safe evening, folks. We will see you tomorrow.